not 30 years from now, but kind of within that whole duration, up and down, right? And it's trying to pay you like a reasonable yield based off what they think inflation will be. Why does that matter? Who wants to own a fixed yield when inflation's going higher, right? The value of that yield, you'll get paid it, but the value of it will be worth less money. The purchasing power will be worth less money as inflation goes higher. And so what dictates the long dated bond is where the bond market thinks inflation will be. This is key. This is really important. And so that's why I'm looking at TLT, right? So let's factor that in. Okay, so stocks went down, uncertainty up, fear skyrocketing, but we just got inflation numbers showing us, incredible progress within the inflation dynamics. The CPI year over year was at 2.4, and it's consistently going lower and lower towards that Fed's 2% target. Now, even better, if you look at the 3-month annualized CPI, which if you're going to get the year over year to 2, you need to see the 3-month annualized be well below 2 for many months in a row. It went below 1%. This should be celebrated by the bond market. Inflation is certainly cooling down, yet doesn't care. So what's really going on here? And what I think is going on is not the CPI, which is measuring inflation today, or really, last month, excuse me. But what's really dictating this is what the bond market thinks inflation will be going forward. Okay? And what really matters are these numbers right here. The US debt divided by GDP is at 121%. The US deficit divided by GDP is negative 6.3%. So we're running about a 6.3% deficit to our GDP. So I realize not a lot of people really understand what I mean by that, let alone know what these factors mean. And so I want to dive into this so that you understand what's going on and understand what this bond, long-dated bond, is signaling to us as investors. So if we dive in where we're at, US GDP is roughly $30 trillion, right? Think of this as the revenue side of a balance sheet. US total debt, how much that we owe, is $36 trillion. Okay, so we owe more than we make on an annual basis, giving us a debt to GDP ratio of 121%. Okay, so think about revenue as like how you're going to service this debt, right? So debt, what matters is not necessarily the principal being paid back, but how much is it going to cost you to keep that debt alive? So what's the yield on that debt you have to pay every single year to service it? The higher this debt number goes in relation to GDP, the higher this number goes and the more of a problem you have, right? So diving a little bit deeper, U.S. government spending in the U.S. is estimated to be about $7 trillion. Our tax revenue currently, and forgive me for having this, I'm pulling this data from Y charts and they're pulling it in billions, but it's in trillions. So anyway, that's why it looks kind of goofy. But anyway, so it's about 7 trillion in government spending. Our tax revenue, it covers about 5.2 trillion of that. That leaves a deficit of 1.7 trillion. So how do we cover those bills? Easy. We just borrow money. We just issue government bonds and government notes. That's how we do it. Currently, it's about $1.7 trillion in bonds that have to be issued in order to keep this ship going forward. Now, we're currently at a deficit of about 6%. For reference, I want to show you other periods in time. So what was going on in 1934? The Great Depression, 5.3% deficit. 1943, coming out of the World War II, 26% deficit, were the highest on record in the U.S. 1992, coming out of a really nasty recession, 4.4%. 2004, coming out of a really nasty recession, 3.3%. 2009, coming out of the worst recession, 9.7%. And 2020 was the COVID response at 14.6%. And in 2024, what happened in 2024? Can anyone think of something that would justify this kind of government spending, this kind of deficit? I mean, it was higher than period in the Great Depression. Nothing. No, there's nothing happened. Nothing justifies this. Yet this is what happened. What we learned from 2023 and 2024 is that excessive government spending can keep a weak economy out of a recession. That was the lesson learned. If it was the wise move, I don't think, probably not, because this is now the new norm, apparently. But this is what that means by U.S. deficit to GDP. The higher that number, the more of an issue you have, right? The more of a hole you have to fill by issuing debt. So moving a little bit deeper, this year alone, the U.S., we have to refinance about $9.2 trillion we have to refinance that. We have to issue debt to refinance this much. All right, principal that's basically being paid back, and that we have to find more debt. We've issued some of it. I think we're at about 7 to 6 trillion now that has to be refinanced. Still a large number. Next year, it's estimated to be around 5 trillion. Together, that's 38% of our total debt that has to be refinanced in the next 2 years. Okay? Now, here's where it gets interesting. Currently, the yield on the 10-year bond, and keep in mind, if they're issuing 10-year government bonds, 20-year government bonds, in order to service that debt, they have to pay this percentage, this yield every year to keep the ship afloat. Currently, the yield is 4.4%. The cost to service our existing debt is over $1 trillion. It's more than we spend on defense. It's one of the biggest budget items on our debt, on our spending, is servicing the existing debt. So here's what I want you to understand, why inflation matters so much and how you can kind of get into this loop that I'm about to explain. Okay, whenever you have debt this high and deficits this high and no plan to really shrink them, you have three options as a country. One, you can grow your way out of this debt. Okay, so in other words, if our deficits are 6 to 7%, then our nominal GDP growth for that year needs to be 7% minimum just to stay even or higher. If we can get our GDP up to say 8% and keep our deficit at 7%, then we can over time grow our way out of this debt. That's really hard for a country and an economy as big and mature as the US to grow at that level. What does the bond market think of that plan? Not going to happen right now. Don't see a path forward with that. The other option is that you can default on your debt. Now, for those that think that that's impossible, this is a list of industrialized countries since the 1900s that actually did default on their debt. Germany, Japan, Greece was the most recent. Russia, Austria, Italy, France. You'll notice the 30s and 40s were around the time when all this happened, But to think that big countries can't default, it does happen. And if you look at, emerging markets, I mean, it happens all the time. Latin America, Argentina, look at that. Brazil, Mexico, Venezuela, Peru, all over the place. China did in 1939, India in 1958. So it does happen. I don't think that'll happen here. I don't think anyone in the world, even our worst enemies, want the U.S. to default on their debt. That would be a nightmare scenario. I don't think it's going to happen. Which leaves you with the third option, which is what happens most frequently throughout history, is that we just inflate our way out of the debt. We just print more base units in order to pay and service the debt, service our obligations. And so that is what the bond market is picking up on. It's saying you're not going to grow your way out and probably not going to default. If it was going to default, I mean, you'd see TLT tanking. Instead, what they're saying is, okay, you have no solution for solving the problem, which means your only solution will be to inflate your way out of this. Who wants to own a fixed yield of 4.4% if all of a sudden inflation is going to be growing at 3 to 4% annualized over the next, several 10 years? The bond market is saying, if you want us to own your debt, then we need to get paid a higher yield. The problem is, the higher this yield goes, the higher this number goes, and the higher we have to borrow in order to service the debt. And that's what's called a debt loop, right? Whenever countries get in a debt loop, you tend to see a disorderly unwind of the bond market. Nobody wants to own the bonds, so they sell them, which pushes yields higher, which causes the deficits and the budgets to get blown out, making it more of a problem. So that's what's going on right now. And so what we're going to talk about next is what have been the attempts to solve this problem and what we're doing right now. There's been a pivot this year on an attempt to solve this problem and what this means for the equity markets. So, for anyone that's new to this, I'm not a macroeconomist. I follow a handful of them, and the person who I think probably the best in the world, arguably the best in the world, in my opinion, and has done significantly more research on this than me, is Darius Dale. And so 42 macro. And so if you want to get into the math and get into the numbers and see, chart after chart after chart talking about this in thorough detail, that's where you want to go. This is just a generalized explanation of what's going on. Okay. So we just recently saw an attempt to solve this problem, to solve this problem right here, the debt to GDP ratio, by attempting to address the debt part of the equation, right? So Doge, very politically popular. They were estimating to cut $2 trillion from this number, from the $7 trillion spending. Now, that's not really, it's significant, but it's not enough, really. But it gives you within earshot of growing your way out of the debt problem, right? If instead of $7 trillion, you're spending like $5 trillion, then, you've got a shot. Your deficits aren't that big. You can probably grow your way out of the debt. Doge came in at 170 billion. That's what they figured out on cutting. All right. That's only 2.5% of this 7 trillion. That's nothing. It might as well not even happen. It seems like a lot of money. Obviously 170 billion is a lot of money, but compared to 7 trillion, it's really not. That's not going to solve the problem. So why did it fail? It's not politically popular to address the big problem of cutting entitlement spending. That's where, if you really want to address the problem, you got to go. And the other issue is that if you cut government spending, people get fired. These are jobs that get cut. And so therefore, unemployment goes higher. You likely tip your economy into recession, which is also politically not popular. So that failed. The trade war, the tariff war, believe it or not, was an attempt to address this issue. By raising tariffs, it offers an alternative form of income. I don't want to get into the weeds on that, but it does. But more importantly, it ultimately will bring manufacturing back to the U.S., which is an improvement to the middle class ultimately, and makes the U.S. more self-sufficient. It's really a way to kind of like correct the wrongs of globalization, which obliterated the middle class. It's kind of correcting them. However, the bond market basically nixed that problem. That issue, that attempt. And what I mean by that, just to show you what I mean by this, so you can understand what I'm talking about. What you're looking at here is GDP in black, right? The red line is our government debt, total government debt. And the blue line is liquidity, like U.S. domestic liquidity. If you're going to purchase debt, it'd be coming from this right here, roughly speaking, okay? So, as you can see, GDP and debt kind of, around the 100% mark, then all of a sudden around COVID, it just exploded. And that's how we got to 121% right there. So our GDP is not enough to cover our debt expenses. So why liquidity matters is, for the first time ever, in a meaningful way, we saw debt grow higher, more than our domestic liquidity, meaning that if we're going to pay for this debt, it's not going to be coming from the U.S. totally, right? So we kind of are relying on foreign investors. And you can really see it in this number right here, net international investment position. For the U.S., it's a really simple equation. It's basically taking how many foreign investments are in coming to the U.S., and then subtracting it by how many investments the U.S. are making in foreign countries. It's currently at negative $26 trillion. That's how much, investment is coming into the US compared to how much we're doing outside the US. Okay. And so you can't go around, being the tough guy with all these foreign players trying to tell them, raise tariffs on them and try to be, Mr. Tough, no, strong arm them, basically, if you will. When you depend on this much foreign investment, when you need foreign investments to cover your debts, that's a problem. And that's what happened. The bond market basically said, we're not going to allow this to happen. And why that, it's not like there was a conscious decision. It just means if all this foreign investment is going away, and when you raise tariffs, it naturally will. It just basically means that some businesses won't be able to do business in the US, right? So that's less investment in the US. It also, to compensate for tariffs going up, the dollar goes down against other currencies, and it went down to a level to where buying US treasuries after you hedge that currency became not a good investment. So that money was going away. And then also, as manufacturing gets reshored, that's less dollars in the system to buy our treasuries. And so that money was going away. And so the tariffs, by raising them, meant that there's going to be less investment in the US inherently, which we cannot afford. So the bond market said, well, okay, if we're not going to get that investment from foreign players, we're just going to raise rates until we find investors. I mean, the bond market is the 800-pound gorilla in the room. It just is. And so that, as we know, can't happen because we can't afford that. And so what happened was we saw a pivot away from this attempt to solve the equation from the debt part, cutting government spending, and a pivot into trying to grow our way out of this. Now, as we said, it's very unlikely that will happen, but it doesn't mean that equities can't do good over the short to intermediate time frame. The attempts to do this is to reduce regulations with banks, the SEC, and also the AI build out. We're seeing a reduction in regulations. We're seeing taxes get cut. These are supply side incentives. And the big, beautiful bill is estimated to increase the deficit from 1.7 trillion to 3 to 4 trillion. Okay. So as long as the bond market does not break down, then this right here is quite bullish for equities. It's not good for inflation, and it's not good for those that don't own assets. But it is structurally positive for equities as long as the bond market doesn't break down, right? Let's say the big, beautiful bill gets passed. Then all of a sudden the calculations on what we're going to spend on, interest payments and deficits could be too much. And we could see the bond market truly break. And what do I mean by that? You would see TLT, which is right here. This is my count for it. I've shown it many times. You'd see TLT break this 85 to 82 level and start heading towards 71 to 66 right there. Why is that a problem? As bonds go higher, go lower, yields go higher.